May 22nd, 2008, this is vlog number 28 for AbsoluteGains.com. You had to know with the market headlines being as they are that today's post would have something to do with oil and commodities. So to not disappoint, I've got two names that are going to suffer this summer as a result of economic conditions. Here's a quick look at Dillard's. This is a 200-day chart. Obviously, the stock has been in a downtrend for quite some time now, but I believe there's more of the same to come. However, the chart is sending me mixed signals. If you draw a quick trend line, you can see how these are lower highs at each peak. That's excluding the last one, of course, which came after a fluke pop to the upside on April 2nd. But what's got me cautious is number one, the huge move down over the past week, which is just waiting to recover a little bit, and number two, the usual cycle we're seeing here from bottom to bottom. If you look at the last four bottoms, they're all about 8 weeks apart. Well, here we are about 10 weeks out from the last bottom, which suggests another recovery before it's going to pull back again. Although I'm awfully tempted to get in short here, I'm going to play the cautious angle and hold out for a recovery and then reevaluate. As a note, their next earnings report is June 16th, which falls right about where the next peak would be if this cycle continues, and that would be the perfect place to go short. Secondly, a quick look at Claiborne. I want to short this name for so many reasons, but I can't yet because again the chart is making me cautious. See how it's bounced up when hitting around $16 three times now? That makes me nervous of being short. A little enthusiasm in the sector could start a little rally for the stock. So, I'm just going to be watching this one really close for a break through that resistance. If that happens, we'll see the price sink way further down. Aside from the charts, I'm bearish on these names because of what I said at first, economic conditions. This is an indirect way to play rising commodities costs, and I think the smartest way to do that is to short the middle class American consumer. And here's what I mean. Lower to middle class people will keep shopping at Wal-Mart and Target for low prices. That's a given. I think oil's a little risky right now because we're in uncharted territory, and also even if Americans do decide to stop driving so much, oil is a world demand story. So regardless of what we decide to do in America, the price could fluctuate either way. Also, it remains to be seen whether places like Tiffany's and Coach will see a big effect on their share price during a recession. One argument says wealthy people will shop and get what they want whenever, but the other side says wealthy people will have to adjust just like everybody else during a recession. So that one's still up in the air. But what will happen is there will be a change in the upwardly mobile middle class American. What used to be slight luxuries for them, things like Claiborne and Dillard's, will be replaced by cheaper alternatives. That's the smart money right now.
All content contained on and associated with AbsoluteGains.com is only an opinion.